Yo, my name is Sebastian Salvela. So say that you're someone that decided to take their personal finances seriously and found ways to save more and spend less. So one of the reasons you want to do that is to make sure that you have enough money set aside to live comfortably in retirement. So say that you're at that stage where you have an emergency fund and you pay down all your high interest consumer debt and you're now ready to invest. Well, there's a bunch of different options out there, but you decide that you want to make investing as simple as possible. Investing in the stock market seems like a great option, but now you're stuck because you don't know if you should invest in individual stocks, bonds, index funds, or ETFs. Well, if that's you, you should keep watching this video because I'm about to make a strong argument as to why investing in index funds or ETFs is the best option for most people. The only reason you invest your money is so that you can make more money, period. So you work hard and you sacrifice a lot for that money. So you want to put it somewhere that's relatively safe and that makes a return. I mean, no investment is risk free, but it can be minimized if you understand the business behind what you're investing and what drives a return. You also need to understand risk and know how much of it you're willing to take. The less risky the investment, the less returns you could expect, and the less likely you lose your money. But the more risk you take, the more potential for a bigger return, but you could also lose it all. So an example of that is putting your money in a savings account versus going to a casino. So in a savings account, there's basically no risk, but you're only making 0.01 to 2% of your money. That kind of return won't get you far. In a casino, you can make 100% or double your money, but there's a strong chance of you losing everything. In the stock market, it's very volatile, so it goes up and down. So some year you might be up 20%, and some years you might be losing money. But on average, over the long term, you could expect a return of 6 to 10%. So if you're trying to invest in an individual company, there's a lot of research that goes into picking which company stock to buy. So you can't just go read a couple of articles or talk to a friend and invest in a company just because they say it's a good investment. So you need to know what the company does, what they sell, or what kind of service they offer. Is it something you use? Is it something other people use? Can you see more people using it in the future? How do they make money? Are they profitable? Are their profits increasing year over year? Are they growing? Are they gonna continue making money? Are they investing in themselves so they could keep up with the market? You'll have to read their earning reports and SEC filings to get a good sense of their financials. So whenever you buy shares of a company, you become a part owner and you get voting rights. So if you're investing all this money in this company, it's probably a good idea to know who the CEO is and who's on the board of directors making decisions. You'll want to listen in their conference calls to get a good idea of their visions and their plans for the company to make sure that your money is safe. Now, you can't just put all your eggs in one basket because if that company fails, then you lose everything. So, you want to look for other companies to invest in and preferably in different sectors of the market. So, you can't just have all tech companies. So, you want your portfolio to be diversified to minimize risk. So you might want to invest in energy, real estate, healthcare, financials, and so on. So imagine having to do that same type of research, not just for one, but for a dozen companies or more. Buying individual stocks is also expensive. So how much money do you think you'd need to buy a couple shares of Amazon or Apple or Coca-Cola? To own a sizable amount of all these different companies and actually make money is going to cost a lot that most people don't have. The worst part is you have no guarantees that any of them is going to succeed. Picking winning stocks is incredibly difficult because you can't predict the future. There are countless examples of companies that used to be on top and showed no signs of slowing down until everything went down the toilet. So companies like Nokia, BlackBerry, Blockbuster, Sears, Lehman Brothers, Radio Shack, Avon Products, to name a few. So all these companies at one point seemed like they would be on top forever. You think investors were able to predict their downfall? Or say that you invested in a company or the most valuable company today. So who knows with 100% certainty that they'll still exist in 20 to 30 years. And if one of your companies starts to lose money and the shares starts to drop year over year, at what point will you know to sell your shares? So imagine loving a company and investing in it for 10 years straight. You'll have an emotional attachment to it that will definitely cloud your judgment. So you tell yourself things like, let's just wait another year, or the market will turn, or the price will go back up. No, it won't. or maybe it will. Another aspect you need to understand is who you're competing against. So when you're buying and selling, who's also buying and selling? So a lot of times you're competing against large scale investors like big financial institutions or hedge fund managers. So these guys live and breathe investing. So they have way more money, they understand more about the business, and they can react to different information faster because of their advanced computer systems. So by the time you hear somewhere in the news that it's a good time to buy or sell, it's probably already too late. So what's the alternative? So that's investing in index funds or ETFs. So they're a group of securities that follows an index. So the securities could just be stocks or bonds or commodities or other type of securities, or they could be a combination of all of them. So an example is the Vanguard 500 index fund investor shares, and it follows the S&P 500 index. Now that index contains the 500 biggest companies in the US, so that fund also contains those same 500 companies. So if you buy one share of that fund, you're instantly diversified. So you instantly own a piece of 500 different companies in different sectors. The only extensive research that you would have to do is at the beginning. So you want to know how much risk you're willing to take. So do you want only stocks for rapid growth? Or do you want a combination of stocks and bonds so that during a recession you can recover much faster? What kind of returns the fund has been getting? Is it accurately following the index it intended to? How much are you willing to pay in fees? How long the fund has existed and how much money do they have under management? What's the total asset? What brokerage are you getting it from? Once you invest, all you have to do is dollar cost average, meaning that you keep contributing the same amount of money every month and reinvesting the profits for the next 15 to 30 years. You don't have to worry about what the market is doing in between. If a company is not doing well, you have hundreds and sometimes thousands of others to lessen the blow. And because you have all these different companies, you also won't miss out on the winners. So somebody investing in individual stocks might have 10 companies that are doing good, but might miss out on the other companies that are doing great and outperforming the market. Still not convinced? Or you could do a simple Google search and find plenty of articles and studies showing why picking individual stocks is not a good idea. If you still want more, Warren Buffett, probably the greatest investor of all time, had this to say in his letter to his shareholders in 2013. My advice to the trustee could not be more simple. Put 10% of the cash in a short-term government bond and 90% in a very low-cost S&P 500 index fund. I believe the trust's long-term results from this policy will be superior to those attained by most investors, whether pension funds, institutions, individuals who employ high-fee managers. So he's saying out of all the big shots and professional managers picking stocks, if you invest in a cheap S&P 500 index fund for the next 20 to 30 years, you'll outperform them all. So how do you actually make money in the stock market? Well, there's two ways. So one is the value of the stock going up, and two is by getting paid dividends. So with individual companies, you worry about the company going out of business, or if it's still growing, it can keep paying those dividends. With index funds and ETFs, it's very unlikely that all the different companies in the fund are going to go bankrupt at the same time. So the only thing that you have to worry about are recessions, but you need to understand that recessions are a normal part of the cycle and that you can't prevent them from happening. So if you were to retire during a recession, that might hurt, but if you could wait it out and keep investing, eventually the market will recover. Let me quickly show you what would happen if you invest $500 every month for the next 30 years in an S&P 500 index fund. Assuming an average return of 9% and plugging that in a compound interest calculator, you would have contributed $180,000 total. But the value of your money would have grown to over $800,000. What if you contributed $1,000 a month? What if you max out your 401k and put $19,000 a year? Use a calculator and see for yourself. Now remember, not all financial advisors are trying to steal your money. So if you're still confused or need more guidance, you should definitely go see one. So with that, that's all I got for today. If you think this video was helpful, follow me or subscribe wherever you prefer watching videos. And don't forget to like, comment, share, or tag a friend. Thank you guys so much for watching, and I'll see you next week. Peace!